money-hungry institutions, weak regulation, and pure greed. These were some of the biggest culprits for the 2008 financial crisis. A crisis that had people sick with anxiety every single day, wondering if they could afford their next meal. A crisis that devoured the mental health of so many people that they were driven to take their own lives. A crisis that shattered our trust in banks, financial institutions, and the government. In this video, I'll be zooming in on the causes and consequences of one of the largest financial crises that humanity has ever seen. Before the crisis, the global financial system seemed strong. The housing market was booming, with home prices soaring across the United States. From 1997 to 2006, the average price of a home in the US more than doubled. As home prices kept rising, everyone, from homeowners to investors, thought this trend would never end. This widespread belief encouraged risky behavior from both lenders and borrowers. Banks and mortgage companies started giving out subprime mortgages, which are essentially loans for people with poor credit. These subprime mortgages had high interest rates and were often given without checking if borrowers could repay them. Borrowers, drawn by the dream of owning a home and convinced that home prices would keep going up, took on more debt than they could handle. Many signed up for adjustable rate mortgages, which had low initial rates that would later increase, making their monthly payments too high to afford. By 2006, 1 in 5 mortgages in the US was subprime. This created a massive housing bubble that was sure to burst once people started defaulting on their loans. The 2008 financial crisis had several main causes. One of the biggest was subprime mortgages. When home prices stopped rising and started falling, many homeowners found themselves owing more on their mortgages than their homes were worth. Unable to sell their homes or refinance their loans, they defaulted in large numbers, creating a wave of financial problems. Another major cause was financial deregulation. In the 1990s and early 2000s, the government reduced the rules overseeing financial institutions. One important change was the repeal of the Glass-Steagall Act in 1999, which had kept commercial banks and investment banks separate. Without these regulations, banks engaged in riskier practices to make bigger profits. Securitization and complex financial products also played a crucial role. Banks bundled subprime mortgages into mortgage-backed securities, MBS, and sold them to investors. These MBS were then further divided into collateralized debt obligations, CDOs. These products were sold worldwide, spreading the risk. Investors bought these products because credit rating agencies gave them high ratings, failing to properly assess their risk. When homeowners began to default, the value of these securities dropped sharply, leading to huge losses for investors. Credit rating agencies were supposed to evaluate the risk of these financial products, but they often have high ratings to risky MBS and CDOs due to conflicts of interest and flawed models. Their failure to accurately rate these products misled investors into thinking they were safe. Financial institutions also took excessive risks, driven by the desire for short-term profits. Banks and investment firms heavily invested in MBS and CDOs, using borrowed money to boost their potential gains. This leverage meant that when the value of these securities dropped, their losses were enormous. Major financial institutions, including Lehman Brothers, Bear Stearns, and AIG, faced collapse because of their exposure to bad mortgages. The financial system fell apart very quickly and dramatically. It all started when the housing market crashed. As home prices dropped, more homeowners couldn't keep up with their mortgage payments, leading to a huge number of foreclosures. This pushed home prices down even further and spread financial trouble. In 2007, banks and investment firms began to suffer. They had invested a lot of money in risky mortgage-backed securities. As these investments lost value, the banks faced huge losses. Bear Stearns was one of the first major companies to collapse. In March 2008, it was about to go bankrupt because of its bad mortgage investments. To avoid disaster, the government arranged for JP Chase to buy Bear Stearns at a very low price. Things got worse in September 2008 when Lehman Brothers, one of the biggest investment banks, went bankrupt. This was a huge shock to the financial system, causing panic and making people lose trust in other financial institutions. The stock market crashed, and it became almost impossible for businesses and consumers to get loans. The government had to step in to stop a complete collapse. The US Treasury and the Federal Reserve took drastic actions. They bailed out major financial institutions like AIG, an insurance company that had sold a lot of risky financial products and was about to fail. The government also took over Fannie Mae and Freddie Mac, two big mortgage finance companies, to help stabilize the housing market. To restore confidence and stabilize the economy, Congress passed the Emergency Economic Stabilization Act in October 2008. This act created the Troubled Asset Relief Program, TARP, which allowed the government to buy troubled assets and inject money into banks. Despite these efforts, the economy continued to struggle, and the stock market was still unpredictable. The 2008 financial crisis had severe consequences that affected people worldwide. Economically, the crisis triggered a global recession. This meant that the economies of many countries shrank, with millions of people either losing their jobs or seeing reduced or frozen wages. People's savings and investments lost massive value, hurting their financial security. Retirees and people close to retirement were especially hard hit as their retirement funds dwindled. Politically, the crisis led to massive changes. Governments around the world introduced new regulations to prevent a crisis like this from happening again. In the United States, the Dodd-Frank Act was passed in 2010. It introduced stricter rules for banks and created agencies to monitor and manage financial risks. The crisis also shifted political power and influence. People became more skeptical of financial institutions and the government's ability to regulate them. This led to movements like Occupy Wall Street, where people protested against economic inequality and the power of big banks. Long-term, the crisis changed the financial industry in many ways. Banks became more cautious, and there was a greater emphasis on risk management. The crisis also sparked ongoing debates about financial regulation and economic inequality. People began to question the fairness of the financial system and demanded changes to make sure of greater stability and equity. The 2008 financial crisis taught us many important lessons. One of the key takeaways is the importance of strong financial oversight and regulation. Before the crisis, there were not enough rules to keep risky behavior in check. This allowed banks and other financial institutions to take on too much risk, which eventually led to the crisis. We learned that having clear and strict regulations is key to maintaining a stable financial system. Another important lesson is the need for transparency and accountability in financial markets. Many of the financial products that contributed to the crisis, like mortgage-backed securities and collateralized debt obligations, were very complex and not well understood, even by the people who bought and sold them. This lack of transparency made it difficult to see the risks involved. We realized that financial products and institutions need to be more open about what they are doing so that everyone can understand the risks. We also learned about the dangers of excessive risk-taking. Banks and other financial institutions were driven by the desire for short-term profits and took on too much risk. This was especially true with the use of leverage, where banks borrowed a lot of money to invest in high-risk financial products. When things went wrong, the losses were huge. The crisis showed us that it's important for financial institutions to balance profit with the need for long-term stability. The 2008 financial crisis was a wake-up call for the world. It showed us how fragile our financial systems can be and how quickly things can go wrong when there is too much risk and not enough oversight. By learning from the past, we can work towards a future where such a crisis like this never happens again. I hope that you found this video informative or interesting. If you have, don't forget to like, comment, and subscribe for more videos like this.